I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, they're coming! Rather, Q is coming, QE is coming! Sorry, just don't call it QE. Since March 2023, the Federal Reserve has trimmed its balance sheet to around $6.5 trillion from the record of $9-something trillion. In October, the Federal Reserve announced the end of its nearly 3-year-old quantitative tightening cycle. At the December Federal Open Market Committee meeting, the Fed reiterated that it would start to purchase tens of billions of dollars in short-term Treasury securities. This is terrific news for the Treasury because if the Fed is buying as much as $40 to $80 billion per month, this will apply less pressure on the central bank and represent about half of the financing of the federal deficit. The Treasury already confirmed that nearly half of all net issuances of securities will be T-bills in the first quarter of 2026, which have maturities of about 1 month to 1 year. While this appears to be QE on the surface, officials are referring it to as a reserve management purchase, with the purpose to stabilize short-term funding markets. No matter how it is described, why is the Fed even engaged in this? For one, the Fed is worried about stress in the repo markets because interest rates keep spiking, signaling tight liquidity in the overnight funding market. While it may seem like gobbledygook to the average person, the repo and overnight markets are sort of the machinery that keeps the entire financial system afloat. When chaos reigns in these areas of the system, everything else starts to wobble. Second, when reserves become too scarce, the Federal Reserve loses control of the benchmark federal funds interest rate, which is currently in the range of 3.5% to 3.75%. And remember, the federal funds rate influences everything from mortgage rates to credit card interest rates. So by buying T-bills, the Fed will keep overnight rates aligned with its target. Finally, according to Federal Reserve Chair Jerome Powell, the institution is doing this in advance of tax filing season, or more specifically, April 15th or tax day, when everyone sends a huge check to Uncle Sam. By supplying financial markets with enough cash, there isn't a threat to bank reserves. Still, at a time when the Federal Reserve is cutting interest rates and accelerating the money supply, the average person can't help but think that this is another round of QE. Perhaps it is QE light. Rate cuts, money supply expansion, and balance sheet growth. Does this mean another round of inflation is on the way? 2026 could be the year of purchasing price deterioration for the American public. That's it for this week. Please read my full stories on libertynation.com and be sure to check out my previous Swamponomics TV videos and interviews. Liberty Nation does not endorse candidates or campaigns or legislation, and this presentation is no endorsement. Thank you.
I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.